Welcome to this video. Please acquaint yourself with the question before you proceed, because we will go through this question pretty quickly, so you want to be familiar with it first. So this video is on accrual accounting and adjusting entries. So we will be using Earl to help us figure out what will be debited and what would be credited. Just a refresher on Earl. Earl tells us what to debit or credit when you're getting more. So expenses and assets are debited when you get more and credited when they are reduced. On the other hand, revenues and liabilities are increased on the credit side and decreased on the debit side. So one really important point about adjusting entries is that they're always going to impact an income statement account and a balance sheet account. So that means you're either going to be debiting expenses or crediting revenues, and then the other half will either be an asset or a liability. All right, so let's proceed with the first part of this question. One thing to note is the date. So these are all the entries are going to be December 31st. And it's really important to also note the time period in many of these questions. So this question's a little bit funky. It just says for the accounting period. When we get down into the question, you'll see that it's for the year. So basically, we'll be capturing information from January 1st, 2017 to December 31st, 2017. The point of the exercise is to make sure that what's in the accounts at this date, December 31st, 2017, belongs in that year. Okay, so here we go. The first question is that each Friday, our company pays employees for the current work week. The amount of payroll is $5,000 for a 5-day work week. The current accounting period ends on Tuesday. So if we think about this, Monday and Tuesday are in that 2017 time period. So what we need to do is make sure we capture what's used up. We used up our employees' time during 2017, those 2 days. Now, we're going to add that amount to the salaries expense. And in this question, it doesn't tell us how much is already in the salaries expense account, but we know that throughout the year, we would have been debiting that account every payroll to make sure that our employees are paid, to show how much we've been paying our employees throughout the year. So we're just adding those extra 2 days because they worked during those 2 days. Our balance sheet account is a payable. On December 31st, we'll owe our employees for those 2 days. The money will actually come out of our bank account on Friday, January 3rd. So at December 31st, and that's the point we're worried about, we're going to have some salaries payable. So let's look and see how we do this. So we have 2 of the 5 days that are in the time period in question. So if we take that $5,000 and times it by 2 out of 5, we'll get the cost for 2 days. So let's just do that. The other way to do that is to take the $5,000, divide it by 5 days, and times it by 2. You'll get the exact same amount, $2,000. So now let's make our journal entry. We're going to debit salaries expense for $2,000 and credit salaries payable for $2,000. So once we do that and we'll report that we owe our employees $2,000 as of the end of the year, and our salaries expense has increased another $2,000 because of those 2 days. Our debits equal our credits, things are happy. Now, in real life, you would definitely want to include a note with your journal entry, because you do so many journal entries you forget why you do it. For the purposes of this class, we're not really that concerned about the note. Just to clarify, everything in yellow here is what I'm thinking about when I answer this question. The actual answer to the question is in white here. All right, let's go down to B. So our company has received notes receivable for some clients for services during the current year. We've earned interest revenue of $1,100, which will be received next year. All right, so watch out for this word accrued. Accrued is a very odd word. All it means is that something's happened, but no money has changed hands. And what's happened in this case is, darn, we've earned interest revenue. We've basically loaned some customers some money or our service, and they've agreed to pay us interest in return for not paying straight away. So we have earned that revenue. We just haven't got the money yet. So revenues are always credits. So we've earned that revenue. So what we will want to do is show that $1,100 in our interest revenue. And our debit is going to be interest receivable. We'll show that on our balance sheet. That receivable amount is going up. So using EARL, our assets are going up. So that's why I'm debiting it. And, that will show that, hey, these people owe us $1,100. When it comes to our journal entry, we'll debit interest receivable for $1,100. Whoops. And credit our interest revenue. So that would go in there, top up that account. This would go in here, top up that account, and things are good. All right. On to C. The beginning balance of supplies was $1,800. During the year, we purchased supplies costing $12,500. All right, so those are would be in our supplies account. And now we realize, well, here we are, December 31st. We only have $2,900 left on hand. So we're trying to figure out how much supplies, how much of this $14,300 worth of supplies has been used up. Well, anything that is used up goes into an expense account, because that's basically what expense means. So if we take our $14,300 and subtract the $2,900, that must be what's been used up. So let's do that. Whew, that's the amount that must have been used up. So that's the amount that needs to come out of the supplies account. Where we'll put it is into the supplies expense because it's been used up. The point. So expenses are always debits, so our supplies expense will be debited for $11,400 and supplies credited for $11,400. On to D. So our company is developing software for a client, and the client paid us $20,000 at the start of the project. At that point, we recorded that amount in unearned service revenue. So here it would be in hanging out in unearned service revenue. When we did that, this unearned service revenue is a liability account, so that's why it's sitting there on the credit side. We owe that amount of work to our customer. The software development will take several months. Our executives estimate the company has earned 3/4 of the total fee during the year. All right, well, if we've earned 3/4 of that, then it needs to come out of this unearned revenue account. So let's figure out how much 3/4 of 20,000 is. We'll take the $20,000, times it by 3, divide by 4, 3/4. Oops. Too bad that wasn't $20,000. That helps, $20,000. There we go. So we're going to want to debit $20,000 out of unearned revenue because we've earned it. And then our credit is to our revenue account because that's how much we've actually earned. The value of goods or services provided to our customers. We did it. So for the purposes of this question, we don't know how much is already sitting there in the revenue account. Presumably, we've been doing lots of work throughout the year, so we've been crediting revenue every time we've done work, or our company has done work. The whole idea of this adjusting entry is to fix up these two accounts to make sure we're ready for reporting. And our reporting will be the balances of these accounts. So in this case, unearned revenue will now be that 20 less the 15,000, or have a $5,000 balance that will be reported. All right, on to E. Depreciation for the current year includes computer equipment for $6,300 and buildings for $3,700. Make a compound entry. Well, the great thing about depreciation is there are always only two accounts: depreciation expense and accumulated depreciation. Now, most companies only have one depreciation expense account, so I'm going to put all of that depreciation into that one account. So the $6,300 and the $3,700, because we have computer equipment and buildings, and this is the amount of the computer equipment, the amount of the useful life of the computer equipment, or the value of the useful life of the computer equipment that's been used up during this year. This is the value of the building we have that's been used up during the year. Now, each one of these assets, the computer equipment and the building, will have their own respective accumulated depreciation account. So I need to be very specific here that the accumulated depreciation for the computer equipment gets credited $6,300, and the accumulated depreciation for the building gets credited for $3,700. In other questions, we'll be learning more how to make these calculations and how that works. But for the time being, this question was pretty nice in terms of depreciation. They're already giving you the number. Last but not least, we've got F. And F is all about prepaid insurance. So this is what the prepaid insurance account shows. We have a beginning balance of $1,800, and on September 30th, we bought a year-long insurance policy. So that $3,600 that was purchased, or $3,600 worth of insurance that was purchased on September 30th, is worth 1 year of insurance. So if we take that $3,600 and divide it by 12 months, we'll find that the cost is $300 per month. So October, November, and December of that policy has been used up. That's part of what we want to go into computer or insurance expense. Also, we can presume that that $1,800 has been used up, and that will go into insurance expense because expenses are things that have been used up. And what we want to have remaining in the policy is 9 months worth of insurance, because we'll have 9 months worth to use. We're going to have January, February, March, April, May, June, July, August, September to go in the following year, in 2018 in this question. So if we take 9 months times $300, that's what we want to be the remaining balance in this account. So what needs to come out of the account is, $5,400 negative what's left over, the $2,700. So if we take $2,700 worth of insurance out of this account, that's going to be the ending balance and the amount of insurance remaining to use in the future. And that's the whole point of prepaid insurance. So if that's what needs to go out, it's going to go in to insurance expense. All right, so let's do that. We're going to debit our insurance expense by $2,700 and credit our prepaid insurance by $2,700. Okay, hopefully you found this video useful and informative. Thanks, and have a great day.